JBS just dropped a monster revenue number, and Wall Street is loving it. But we're here to tell you why that might be a huge mistake. Welcome to Iron Financial, the only place that stress tests the numbers to help you forge a stronger portfolio. We don't chase the hype, we inspect the foundation, piece by piece. Today, the global protein giant JBS is on the anvil. They've just released their Q4 earnings, and yeah, the top-line number, it looks like solid steel. But we see some serious cracks forming underneath. So our job is to figure out if this company is a fortress or if it's just a facade. This is going to be a heavy lift. Let's get right into it.
Okay, let's get straight to the heart of the matter. On the surface, the headline number looks incredible. A massive 15% jump in revenue, year over year. I mean, their sales engine is just absolutely screaming. And that is exactly the story the market wants to hear. It's simple, it's powerful, it's growth.
Yeah, but hold on. At Iron Financial, we never, ever just look at the shiny headline. Our job is to dig deeper and ask what it actually cost to generate that shine. And that's where this whole story just completely unravels. Get this, while their sales were soaring, their gross profit, that's the real money they make after producing all that food, it actually dropped by over 3.5%. How does that even happen? How can you sell billions and billions of dollars more in product and somehow end up with less profit? That's not just a red flag, my friend. That is a fundamental structural flaw, and we need to figure out what's causing it.
And that right there, that's the core conflict of this whole report. You've got this massive revenue growth, this shiny new skyscraper that looks so impressive from a distance, reaching for the clouds.
Exactly. But we're not just admiring it from the street. We're the structural engineers. We're putting on our hard hats, we're going to the job site, and we're here to ask the one question that really matters. Is this thing built to last, or is it a polished trap? Is this a beautiful facade designed to pull in investor money before the whole thing collapses from its own weight? That's what we're here to find out.
All right, to answer that, we've got to start at the top. We have to give credit where credit is due. So we're breaking this analysis down, and we're starting with the most impressive part of the report, the top line. You can think of revenue as the main steel framework of a company's financial structure, right? It's the primary, load-bearing part of the whole business. And honestly, on this front, JBS looks like an absolute powerhouse. So first, let's examine the strength of that framework.
Let's just stop and let this number sink in for a second. $23.1 billion in a single quarter. You know, that's more than the entire annual GDP of countries like Iceland or Jamaica. We're not just talking about a big company here. We're talking about a global titan. The logistical scale of this operation is almost impossible to wrap your head around. This is the raw power. This is that main steel beam holding up the entire story of success this quarter. You have to respect that sheer scale before we go any deeper.
Now here's what's really impressive. It's not just about the size of the number. It's about blowing past expectations. The smartest analysts in the world, they all got together, and the number they agreed on, the bar they set, was $22.6 billion. JBS didn't just clear that bar. They pole vaulted over it. They came in $500 million higher. This is the kind of overwhelming force that gets Wall Street's trading algorithms buzzing. It tells the market that global demand is white hot and that their team knows how to sell.
Okay, you got me there. Crushing revenue estimates, that's impressive. And this 15.5% growth number, it looks fantastic on a slide. But this is where our skepticism has to kick in hard. My question is always the same. What did it cost them to get that growth? Look, anybody can goose their sales numbers if you're willing to slash your prices to the bone, or spend a fortune on marketing, or just eat the rising costs of your supplies. So the real question is this strong, healthy, profitable growth, or is it just expensive growth? Because one builds a company that lasts, and the other can hollow out a company from the inside.
And you just hit the nail on the head. That is the perfect pivot, because a powerful steel frame is completely worthless if the foundation it's sitting on is made of sand. So now we're moving away from that impressive top line and we're starting our inspection of the foundation. We're going to drill down into the costs, the margins, the actual profitability. This is where you look for those hairline cracks, those stress fractures that tell you the real story about a company's health.
And here it is. This chart right here, this shows the first major, undeniable stress fracture in the entire structure. Just look at this disconnect. It's alarming. As we said, their revenue grew by a very healthy 15.5%, but their cost of sales, and that's the direct cost of things like animal feed, livestock, fuel, and processing labor, that grew by a staggering 18.8%. Think about that. Their costs are growing way faster than their sales. This is a classic margin squeeze, probably thanks to global inflation and supply chain nightmares, and it is a huge problem. It means they're running faster and faster on the treadmill just to stay in the exact same place.
Whoa, back up for a second.
Let's make sure everyone watching gets exactly what this means in simple terms. You're saying that for every $100 in sales they made last year, they're now bringing in about 115. But for every $100 in costs they had last year, they're now spending almost 119. That sounds like a formula for going out of business. It's completely unsustainable. So don't just tell me there's a problem, show me the damage. What does this toxic relationship between revenue and costs actually do to their profits?
Here's your first casualty. This number is the direct result of that exact problem. Gross profit is down nearly 3.6% compared to last year. Just let that sink in. They processed and shipped billions more dollars worth of product, their people worked harder, their trucks drove more miles, and when it was all said and done, they had less money left over to pay for everything else than they did a year ago. The profitability squeeze isn't some theoretical risk down the road. It's happening right now, and it is eating away at the core of their business.
And the corrosion, it doesn't just stop there. It's seeping deeper into the foundation. This number shows the drop in their operating profit, which is down over 1.4%. And this metric is even more important because it includes all the other core expenses of running a business. Things like marketing, head office salaries, and all that corporate overhead. So the cracks we saw in the gross profit, they aren't some isolated problem. They are spreading through the entire operational structure of this company. The whole building is feeling the strain.
And boom! This right here, this slide, perfectly illustrates the entire bait and switch of this earnings report. JBS beats big on revenue. That's the headline everyone cheers for. But they missed on earnings per share, which is the final number, the one that matters most to shareholders. EPS is just the total profit divided by all the shares out there. Wall Street was expecting 41 cents of profit for every single share of stock. JBS could only deliver 40. So despite all that incredible headline-grabbing growth, they failed to deliver on the bottom line. For me, that is the clearest signal yet of a deep operational weakness. The structure is officially groaning under the weight of its own growth.
Exactly. So let's recap where we are. We've got a massive, powerful steel frame with that revenue number, but we've confirmed there are significant cracks in the foundation, in the profitability. So the next logical step in any good structural inspection is to go down to the engine room. We've got to look at the cash flow statement. This tells us if the company's day-to-day operations are generating enough raw power, enough cold, hard cash to handle all this stress we've just found, or is the engine itself overheating and about to throw a rod?
Okay, now I have to be fair here. On the surface, this number looks very, very strong. Their cash from operating activities is up nearly 26% year over year. That's a huge improvement, and it's a genuine sign of strength. It means when you cut through some of the accounting noise, the core, day-to-day business of making and selling protein is generating a lot more actual cash than it did a year ago. You can't argue with it. The engine in this company is undeniably powerful.
Powerful, yeah, but look where all that power is going. This number, this is capital expenditures, or CapEx. This is the cash they are spending on huge, long-term stuff, like building new factories, buying heavy machinery, upgrading their facilities. And it is up a mind-blowing 58%. So they're generating more cash, which is great, but they are immediately spinning around and spending all of it, and then some, on this absolutely massive expansion. So the real question is this a healthy engine that's being smartly reinvested for the future, or is this an engine that's running way too hot and they're just desperately throwing money at it to keep it from seizing up?
This is the absolute core question you have to ask when you look at a company's cash flow. All of that spending, is it building future value, or is it just burning through the cash they have right now? Is this a sign of ultimate confidence, a strategic move to build an even more dominant global fortress for the next decade? Or is it a sign of desperation? Are they burning cash trying to outrun the awful margin problems we just talked about? You gotta know. Are they building a dynasty, or are they just feeding a fire that's already getting out of control?
And this next slide gives us a major clue to that answer. This is the year-over-year increase in their total liabilities. It's up almost 9.5%. In plain English, that means the company is taking on more debt. When you see soaring CapEx spending combined with a big jump in debt, it sends a crystal clear signal. It means the company's internal cash engine, as powerful as it is, just isn't powerful enough to pay for its own expansion plans. They are borrowing money to pay for today's heavy lifting, which just adds more and more weight onto an already stressed out foundation.
And this slide right here, this completes the whole picture of what's happening in the engine room. Think of this as the fuel gauge on the dashboard. The company's reserve tank of cash is down almost 18% from last year. So let's put it all together. The engine is running stronger, making more cash, yes, but they're spending it even faster on huge projects, they're taking on more debt to do it, and because of all that, their emergency fuel reserves are shrinking. The engine is running hot, it's running loud, and the fuel tank is getting pretty darn low.
Okay, it is time. Time to bring all of this evidence together for the final structural assessment. We've examined the steel beams of the top line and confirmed they are incredibly strong. We've gone over the foundation with a fine-tooth comb and found some very serious spreading cracks. And we've been down in the engine room and seen that it's running hot and burning through its reserves. So now, let's put all the pieces together and deliver the final Iron Financial verdict.
All right, so here is our final structural assessment, laid out plain and simple. Let's start with the good stuff. The steel beams are solid. That massive 15.5% revenue growth is real and it is impressive. And the engine is powerful. A 26% jump in operating cash flow shows that the core business can absolutely generate raw power. But you have to weigh that against some very, very significant negatives. Those stress fractures in the foundation are severe. That margin compression we saw, being driven by costs that are just outpacing sales, that's a serious threat to long-term stability. And the load this thing is carrying is incredibly heavy. Soaring costs and that 58% jump in CapEx, this is a company that is spending like crazy. And all of that leads to the final critical weakness, a leveraged foundation. Rising debt and falling cash reserves is a risky combination, especially when your profits are already getting squeezed.
So our final unambiguous verdict is this. JBS is a company with a powerful frame that is built on a very shaky foundation. The top-line growth is great, the cash generation is impressive, but both are being completely undermined by severe profitability problems and a balance sheet that's getting weaker, not stronger. This is not a simple thumbs-up or thumbs-down investment. It's just not that easy. This is a heavy lift, and it requires extreme caution. If you invest here, you're making a very specific bet. You are betting that this company can fix its crumbling foundation of profitability before the immense weight of its own growth causes the entire structure to fail. So the final question you have to ask yourself is that a risk you're willing to take?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.